we have a view that the U.S. economy is still, several quarters away from a recession. That a lot of the sort of pain that we've observed in financial markets in 2022 is very likely to spill over into 2023 for at least a few more quarters. In terms of when to think about buying risk assets, it's when we get those ambulance sirens. You don't buy when there's blood in the streets. I mean, you hear that all the time in finance. You don't buy when there's blood in the streets. You buy when there's a catalyst to come clean it up.
All right, welcome back everybody to Altcoin Daily. My name's Austin, joined with macro expert and founder of 42 Macro, Darius Dale. Thanks for joining me.
Hey, what's up, Austin? Happy holidays, man. Thank you for having me on the show.
Yes, you too, man. And I've seen you do other people's channels. I think you're dropping great perspective on the macro environment. So I wanted to have you on. Just for the audience, could you just go over your background and then also what 42 Macro is?
Yeah, absolutely. So I've been doing this for a while now. I'm in my 14th year on the job as an institutional investor in finance, sort of cut my teeth on that side of the cloth, sort of really been, kind of charged with building out multiple sort of quantitative macro risk management frameworks, particularly for the buy side. When I left my prior shop a couple of years ago, I left with the idea that, hey, look, there's a lot of new market participants, both in the digital asset ecosystem, but also in traditional financial markets, retail investors that are being supercharged by information, finance Twitter, crypto Twitter, et cetera. And I thought that, hey, look, I think I'm, one of the world's best at what I do. Certainly I've been proven that on the buy side in terms of the services that we provide, and thought it would be a good idea and opportunity for, to educate the broader masses with what I think is, quite frankly, information that is useful for everybody. Everyone, and I think we learned this the hard way, at least a lot of investors learned this the hard way in 2022, which is everyone needs a legitimate macro risk management process. Everyone doesn't need macro. And you notice I keep saying the difference. There's macro, and then there's macro risk management. And I think we do an excellent job at the latter.
So what are your general thoughts? Let's jump right in. General thoughts on macro into 2023.
Yeah, so let me start by further espousing upon the difference between macro and macro risk management, because that will sort of lead me into our general thoughts. So macro is sort of, kind of the school of thought that just says, hey, look, this matters now, so let me focus on it. And then when that no longer matters, and they go to the next chart, it's usually a chart that, it's kind of investors tend to look at, maybe once a cycle, once every few years, et cetera, and then it no longer becomes popular anymore. What I mean by macro risk management is, hey, what's the systematic way we can sort of, kind of isolate the variables that matter most to predicting dispersion within and across asset markets. And, time and time again, we've proven this on the institutional side already. And I think it's becoming increasingly proven on the non-institutional side, which is growth and inflation are the two bigger drivers of markets over the long term. And the reason they're biggest drivers of markets over the long term is because those two variables interplay very nicely and dovetail quite nicely into what I believe is the third biggest variable, or at least in 2022 is the primary variable, which is the liquidity cycle. And so in terms of what our general thoughts on this, in terms of how we think about the next, let's call it 6 to 9 months, 2 to 3 quarters of risk management, I think you go out further than a year, you're generally going to get in trouble. We start with our 42 macro grid framework. This is a systematic tool that we use, again, to help investors predict dispersion within and across asset markets. What we're effectively trying to do is say, hey, where will the economy be in rate of change terms at these various intervals? And how is that, historically sort of dovetailed in financial markets, particularly vis-a-vis through the lens of the policy cycle, the liquidity cycle. And so it's our belief that, the U.S. economy, large parts of the global economy, if you look at our broader model, are calling for deflation. And what deflation means, simply, without getting to the kind of the technical aspects of it all, is that growth and inflation are likely to be slowing simultaneously and at an increasing frequency once you get into the spring and summer of next year. And that's a problem. And the reason that's a problem is it goes to our sort of second sort of thing that we discussed a decent amount in 42 macro, which is that's an issue because the liquidity cycle is actually still in a downturn. Typically what happens is that, asset markets tend to not to like that deflation quadrant where growth and inflation are slowing simultaneously, tends to be the most negative for digital assets, Bitcoin, Ethereum, et cetera, altcoins, et cetera. And what's compounding that is the fact that you have the Fed, ECB, Bank of England, now Bank of Japan, pretty much every major central bank, including the People's Bank of China, all tightening liquidity conditions At the same time, the world is heading into that deeper outcomes in deflation. So that seems to suggest that a lot of the sort of pain that we've observed in financial markets in 2022 is very likely to spill over into 2023 for at least a few more quarters.
So liquidity, lessening of liquidity, obviously bad for markets, bad for investments. Deflation in very basic terms, is that better or worse for investors versus inflation?
Oh, so it depends on your asset class. For the digital asset class, historically, deflation has been worse. But for stocks and credit, inflation has actually been a little bit worse. I think we have some slides on that as well as in the deck. Continue to keep here we go. Yeah, so crypto. So we backtest everything that ticks through the lens of the expected returns, percent positive ratios, volatility, covariance. Again, this is all the sort of institutional frameworks in our process. And what we've seen is that historically speaking, you pretty much have a 50-50 chance of making money in crypto and inflation. That obviously didn't come to fruition this year. Deflation, that back test on an expected return basis, is a little bit worse, is much worse from a percent positive ratio basis. So we're expecting worser conditions, more deteriorating conditions from a price perspective in the digital asset ecosystem, perhaps less of a speed of a decline in stocks, because historically deflation is a little bit less bad for stocks relative to inflation. That's where you typically get the biggest margin compression, is in that inflation regime. And then ultimately, we're likely to see bonds and stocks start to diverge again once we get past several critical thresholds on inflation. Our models, or at least our math, which we've taken and studied, data going all the way back to the 1800s, is that bonds and stocks tend to have positive covariance. They tend to trade, with a positive correlation whenever inflation's, kind of north of 5%. In that 3 to 5% range, that tends to be slight positive correlation to slight negative correlation. And then typically when you get under that 3% range, which is where our model has inflation in the back half of the year, that's when you get into that inverse covariance. So I do suspect at some point in the middle of next year, we're going to start to be able to allocate to bonds again, but I'm not quite so sure that we're through with that process yet, just given the fact that, hey, we have this liquidity cycle downturn that's going to be ongoing. At the same time, inflation is still well above that critical threshold of 3 to 5%. And we're likely to see a significant increase in Treasury supply, at least in the first quarter, perhaps even in the second quarter of next year.
So in layman's terms, Bitcoin at around 16K, you're in no rush to buy, given the macro environment.
No. Look, I mean, I think we're getting closer and closer to levels where it makes sense to start dollar cost averaging. But again, we pride ourselves on being able to time these big financial market cycles. And quite frankly, I think we've done an excellent job of getting investors out of crypto and high beta risk assets broadly, going back to November of last year, November of 2021, when we pivoted. And we expect to have similar timing in terms of getting into that near the lows. So the answer is, assuming we're going to continue to be good at timing, we don't think now is the appropriate price. I mean, just looking at our net liquidity model, and this is projections through the red dotted line is projections through March of next year, based on our expectations for some of the changes in the Treasury General Account balance and some of the changes in the reverse repo facility balance on top of quantitative tightening. It's very likely you could see Bitcoin in the area code of 15,000 by the end of next year. Maybe it'll start getting attractive by then, but my fear by then is that, hey, if we're, because we have a view, let me take a step back. We have a view that the U.S. economy is still, several quarters away from a recession. I think if we have a variant perception, is that the resilience of the U.S. economy is likely to continue to contribute to resilient outcomes in the labor market, and ultimately resilient outcomes with respect to inflation vis-a-vis, the Fed's 2% target. And as a function of that resiliency, it's very likely that this liquidity cycle downturn, this phase one, what we call this bear market, phase one is the liquidity cycle downturn, is likely to extend itself well into the first part of next year. Phase two of the bear market is the recession risk, that's the credit risk portion. And that's, at least according to our math, where you look at things like Goldman Sachs Financial Conditions Index, next 12 months earnings yields, investment grade credit spreads, and then the sort of ratio between high beta stocks and low beta stocks. None of these indicators have even come close to pricing in a recession. So it's our belief that at some point in the first half of next year, maybe by the middle of next year, we'll start to price in that phase two credit cycle downturn. And so, sorry to have a long-winded answer to your question, but to understand the ultimate depths of the decline in Bitcoin, you sort of have to understand when the timing of phase one ends and when the timing of phase two begins. Because if phase two starts at or near the end of phase one, we're going to be declining and pricing in a recession from a low in the market, from a low in broader risk assets. That's an issue. That's how you get to maybe 33,000 on the S&P. If you look at some of our valuation work, like on slide 32, or sorry, what slide is that? Yeah, so we get to like 3,000 on S&P if we pry median price to sales, 2,000 median market cap to gross domestic income. That's if phase one and phase two are together. If you get phase one pause, maybe for several months or a couple of quarters, then you price in phase two, then Bitcoin can rally from, let's say, 15,000 to 20,000 and then go back down to 15,000. If it goes from 15,000, you have to start phase two from 15,000. This is how you get to 10,000 Bitcoin.
How likely in this, the audience at home, this is all just speculation, but how likely would you think a 9K Bitcoin could be in the next 6 months?
Again, based on our modal outcome expectations that a recession is likely to be, 3 to 4 quarters away in the U.S. economy, probably not that likely. So again, we know there's a few indicators that we look at to sort of give us indication on timing of recession. So there's a few. Let's say the understanding recession is this sort of very, kind of non-stationary, very stochastic process that you cannot predict. You're certainly not using any models that would hold water in normal down and distance. And so, what we do is we look at market-based indicators, survey-based indicators, and relationships between, various hard data to give us a sense of, okay, when is a recession likely over the next, next 12 months, time horizon. Anything beyond that is typically not risk manageable from a perspective of a buy-side investor. So now we have the yield curve inverted. History shows that, hey, this inversion, which just occurred in the month of October, suggests that, hey, look, 0 to 6 months forward, historically speaking, you typically only have, you typically have a 0% chance of going into recession. So basically between now and April, history would suggest, based on the historical patterns in this time series, that you're actually unlikely to have a recession in that interval. You're still unlikely to have a recession in the 6 to 12 months forward basis. Again, the percent positive ratio math on that is 75%. So you really have to get into the 12 to 18 months forward time frame to swing that math in a way that's supportive of actually having a recession. So we have that for the yield curve. We have that math for jobless claims, continuing claims as a percent of the labor force. And so ultimately, we still believe that, hey, a recession is a kind of a Q4 2023 event. In terms of starting that, maybe it's a Q3 2023 event. But again, ultimately, if you pull that forward, and obviously there's a number of things out there that could pull that forward. Oh, my apologies. I think my Siri's talking to me. No offense. Sorry, my apologies. But if you pull that forward to, let's say second quarter of next year, or maybe even the first quarter of next year, if we have some significantly adverse price action in financial markets, that's how you get into phase one, phase two being bunched right against each other. And that's how you get to 9K Bitcoin. But again, that's not our modal outcome expectation. Our modal outcome is that, hey, phase one ends sometime in Q1 in terms of liquidity cycle downturn, sometime in late Q1, early Q2. And then ultimately you maybe have to, 2, 3, 4, 5 months to price in, kind of a reprieve, a pause before we have to price in phase two. That could change.
Darius, this next question may be a dumb one. Feel free to tell me that.
There are no dumb questions, man.
Okay, then let's get into it. Obviously, the pro move to buy Bitcoin or buy any asset is to dollar cost average near the top. You're never, near the bottom. You're never going to, you're never going to get the exact bottoms. But when you're looking at all this recession data, generally speaking, is there a better time to buy during a recession? For example, is it when the government announces it? Should it be a little before? Is it start DCAing in the quarter that the recession is called? Is there a best time?
Yeah, so yes, so there's a loaded question. So what we know is that Fed pivots during bear markets are almost always bullish for risk assets. This table is a very busy, complicated table, and so we certainly implore anyone who is more curious about these types of dynamics to come check us out at 42 Macro. But what we know is that historically speaking, you tend not to get an inflection in the bear market until we get an inflection in the liquidity cycle. These are 17 bear markets that we've had, looking at the S&P 500, going back to, kind of the start, Act 1 of the Great Depression. And what we know is that on a median basis, the bear market tends to bottom 1 month after the inflection in the liquidity cycle, which could easily be sometime, in the second half of next year. Maybe, the markets are currently pricing Fed to pivot in September of next year. or you can make the case, or I do make the case that a pause, in fact, is a pivot. And so, you could very well see a pause by, let's call it, March of next year. And so is that the bottom? I'm not entirely sure, just given the guidance that they're unlikely to cut. So it may be the case that the Fed, the actual pivot, the market, in terms of the market interpretation, may be when they actually start cutting, which I disagree with the market pricing. Market pricing is currently for the Fed to get going in earnest in September of next year. We just think that's wrong. Jay Powell has told us we're going to be wrong, and ultimately we think the resiliency of the economy, i.e., not being in recession, at least until the start of this time period, will suggest that they're not unlikely to cut until the first part of next year. And so, in terms of when to think about buying risk assets, it's when we get those ambulance sirens. I mean, I'm sure a lot of your viewers have seen me on other programs talking about this concept, which is, hey, look, you don't buy when there's blood in the streets. I mean, you hear that all the time in finance. You don't buy when there's blood in the streets. You buy when there's a catalyst to come clean it up. You buy when Jay Powell and Lyle Brainerd and Janet Yellen get into that ambulance and turn on the sirens and start, coming to save you. And that's ultimately we could be a year away from that particular catalyst. And so obviously markets will start to try to front run that, given how much forward guidance we now have to live with as investors. But ultimately, it's still probably a late, kind of second half, late 2023 ordeal. I mean, so it's not necessarily shaping up to be a great year again for risk assets, particularly the high beta front.
Any final charts to show us before we flip it back on just us?
Yeah. So I mean, again, look, it's I think, I don't want to boil down, the macro to kind of, Occam's razor, variable. But again, if there's one thing you had to look at to start, which is understanding, hey, the relationship between phase one and phase two of this bear market. And right now we're still in phase one in this liquidity cycle downturn that very much looks to be ongoing through at least the first quarter of next year, perhaps well into the second quarter of next year. You have a lot of other central banks joining the party in terms of the ECB tightening rates, the Bank of England tightening rates in terms of their forward outlooks for interest rates. Japan just widened its policy rate band with respect to yield curve control policy. And so all these central banks, this is Fed funds relative to, the 1 year US dollar treasury yield relative to the Taylor rule estimate, which is a measure of what policy rate should be based on some, very, thoughtful assumptions around inflation and the target. So these central banks are still well behind their respective inflation fight at minus 518 basis points versus the Taylor rule estimate, minus 867 for the ECB, minus 1,008 basis points for the Bank of England, and minus 432 basis points for the Bank of Japan. So it seems to suggest that, hey, look, even though growth is slowing broadly, we got the whole world in deflation, what we talked about earlier. We got deflation likely starting to accelerate to the downside in terms of the economic outcomes starting in the second quarter of next year for most of these economies. And ultimately, the central banks are going to have blinders on with respect to that. And historically speaking, that's usually one of the worst outcomes for financial markets in terms of risk assets and risk appetite. So it's unlikely that we see a significant rally off of a very kind of structural investable low anytime soon from a dollar cost averaging perspective. But I do believe by the time we get into the second half of next year, your antenna should be very high in looking for some of these signs of a potential pivot, and more importantly, a potential pivot after we've really begun pricing in phase two in earnest. Which again, our model suggests we're very, very far away from doing that. So the Fed is already implicitly forecasting a recession. In fact, I would like to show a chart on that because I think it's an important chart to understand that, hey, look, the Fed might not come bail you out as quickly as you think we are, as you're used to. This chart here shows the the U3 unemployment rate, the headline unemployment rate at 3.7%. It's historically low. And the Fed is calling for their forecasts are calling for a 4.6% unemployment rate by the end of 2023. That's a 90 basis point delta, positive delta relative to where we are today. Well, if you look at the history of this time series, there's never been a 90 basis point positive delta in the unemployment rate over a 13-month time frame. So from November of 2022 through December of 2023, that didn't correspond to recession. So this is a Federal Reserve that implicitly is forecasting recession. And I would argue they're explicitly telling us, market participants, anyone who has the ability to do quantitative economics, that, hey, look out, we know there's a recession coming. We're not going to respond to it if you look at our dot plot. And so ultimately, I think investors, their willingness to sort of speculate early on in phase two, which is again the credit cycle downturn, the pricing in the actual recession. I think their willingness to speculate early on in phase two might get tempered by the fact that we could very well see a very hawkish Powell, very hawkish Fed, and more importantly, a very hawkish ECB and Bank of England and Bank of Japan, despite markets really starting to move to price in phase two. So I think there's going to be a time next year where markets are going to get really ugly, and it could be very ugly from a low price if phase two begins right at the end of phase one. It could be very ugly from a more healthy price. Phase two begins from a kind of a multi-month pause in between those processes. So to me, that understanding the timing of phase two relative to phase one is the most important thing I think you can understand as an investor as it relates to kind of starting your dollar cost averaging process again. And by the way, one final thing I'd say, try to understand this concept of dynamic dollar cost averaging. At the hat tip to a friend of mine who gave me a thought process around that, which is, hey, look, use the macro cycles, the liquidity cycle, the grid regime cycle to speed up or slow down your dollar cost averaging. We made a great call earlier this past year, really going back to the fall of 2021, which said, hey, look, you need to get out of all of your digital asset exposure. That was an excellent call. But more importantly, throughout the year at various intervals, we kept getting, is this time? Is this, when buy? When is this to buy the dip? Do you buy the dip here? Do you buy the dip there? And the thought process say, look, the conditions, both liquidity cycle and grid regime cycle, suggest we should, at the bare minimum, be having a very tepid, slow, small dollar cost averaging process if you're committed to investing in that principle. We would argue you still have plenty of time in respect to dynamic dollar cost averaging to really turn that dial up. I would give it at least 6 months, perhaps 9.
I want to have you back on in about 3-ish months. We'll go over these charts, but the links for all your stuff are down below. I encourage the audience to check it out. Thanks, man.
Yeah, awesome, man. Thank you for having me on the program. And look, let's have a great year. I know a lot of people lost a lot of money this year, but guess what? A great mentor of mine said this, and I'm not sure. I'm sure it wasn't him, but he's the one who taught me. So I'll say it: when you put on a trade, you either make money or you get smarter. Never both. And so hopefully, a lot of investors learned some things this year, and looking forward to sort of putting that in their toolbox and taking it into the next year and for the rest of their investment journeys. So I'm happy to be part of that.